Perfect. Good morning, Bruno.
Hey Nick, how you doing?
Good and you.
Good.
Good. So back with another PLA. Today we'll start with your question, Bruno. And we have been dealing with structuring over the last couple of weeks. We've done with various different elements of structuring, from how to fund it, how to actually structure the thing. And so today I'm just going to ask you to do a little wrap up for us, close up the topic, and give your final points on structuring.
So what's more, oh, sorry. So what's more important? Getting tax savings, protecting your assets, or actually being able to get money in order to be able to make more money? And everyone looks at these questions as though there's one miraculous answer in order to actually be able to achieve all of these goals in order to make your business perfect. The reality is there is no perfect solution. There is no perfect answer to that. Each and every individual and each and every business will have their own equilibrium on how they manage their affairs. So we discussed asset protection, we discussed tax efficiency, we discussed financing optimization. And each one of these carries a certain amount of weight depending on what you as a business owner want and need. So if you carry very high risk businesses, as we said, asset protection is going to come to the top of that list, where you want to make sure that your assets are safely tucked away so that no one can come and take them away from you. You want to keep your businesses safe. You want to divide yourself from your businesses so that you can't get into trouble if your businesses get into trouble. And obviously, sometimes you actually want to take away the businesses from yourself. In case you get into trouble, you want your businesses to be safely nestled, maybe in a trust, so that your children can benefit from this. That's when you carry very high risk trades, either in your personal name or through these companies. Financing optimization, tax efficiency is when we discuss your long-term estate planning, saving on estate duty, making sure that your children benefit from your wealth, versus short-term tax efficiency, where you utilize money on a monthly basis in order to benefit your beneficiaries, right? Again, choices that you need to make. What's more important to you? Financing optimization, again, if somebody is very cash heavy, they don't need money from banks and from other shareholders, so their attractiveness to the outside world is almost irrelevant. They need to be able to run their businesses, make money for themselves, and that's really all they would care about. Versus a business owner that has to look attractive because he needs people to invest in his business. Now, all of these are questions that you need to ask yourself in order to get to the ultimate equilibrium of what suits you. Are you more worried saving on tax? But please understand, the more you try and save on tax, right, the less appealing you look. Because ultimately, what people want to see if they want to invest in your business is a very lucrative, high profit business. And a high profit business is going to be paying a lot of tax, right? So again, bear this in mind. You don't want to run a business through a trust, for example, if you later want to go raise financing from another shareholder, because now it's running through the trust. So you certainly don't want that income to run through a trust. You definitely don't want to overburden from an asset protection perspective and separate every single asset you have into multiple entities. Because number one, that's going to cost you a fortune. But number two, you're never going to look attractive because you're never going to have one solid business that's running successfully. You're going to have multiple businesses. And unfortunately, yes, you might be able to convince some shareholders somewhere that if you look at all these businesses collectively, that there's a benefit to it. But the reality is that you have no one company or one entity that actually looks attractive on paper, that has a good balance sheet, that shows good profits. So all of these interact with each other. And once you understand that there is a natural interaction, you can then make the decision to make sure that you structure it properly. And again, it's not to say that you can only have one and not the others, but you cannot have all of them at the same time at 100%. So you may want to decide, as an example, to separate your businesses. Look at asset protection, for example. Separate some of the properties into logical logical separate entities. Some of them do buy-to-lets, as an example. Some of them might do student accommodation. Some of them would do developments that carry high risk. So that's already a nice way of dividing it up, so that at least you separate and you protect your assets within this little group. Tax efficiency, you know what? I would rather pay all the tax in the world, but be making all the money in the world than be saving on tax. So it's the equivalent of owning 100%, right? Owning 100% of something, but only one thing. And you're only making money on that one thing and that one thing only, but you own 100% of it. Or, for example, from a financing perspective, paying a deposit, letting the bank have a mortgage over 90, well, basically the property, but only paying 10% and using that 100 rand that you have and paying 10 towards one asset, 10 towards another asset, 10 towards another asset. Why? Because I'd rather have 10 assets. I'd rather look attractive and be able to get money in and be able to invest and own more properties because the banks like the way that I look, then save money and pay SARS as little as possible, but only be able to afford one property because no one wants to give me money. And so all in all, you have to do an assessment based on these three different core principles. And once you've done this assessment, you set up your structure according to that. And that may be a trust, that may be a company. You know what? In some circumstances, using your personal name for certain trades isn't a bad idea because there's certain benefits to that. But only you can make that determination. And after consulting with someone, or at least considering all these principles, that's when making the determination comes in. And remember, don't make a decision now and say that later you'll fix it. Because unfortunately, especially with properties, because they're high value assets, later is often not a feasible option from a cost perspective, because it costs so much to fix it later. So these are questions that you should be answering now. And once you've answered it, let's get that ball rolling and get your structure into place.